Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. As Chief Market Strategist at Jones Trading, Mike O'Rourke spends his time studying price, flows, and policy and the complex interaction among these factors. Getting his start in the mid-90s as the tech bubble was gaining momentum and both the Asian currency crisis and LTCM event would occur, he's gained an appreciation for how impactful flows and crowdedness can be on asset prices in both directions. The study of markets is complicated by agents of price-agnostic demand. Here, Mike points to the era of activism and transparency among central banks in the post-GFC era of disinflation. He makes the point that this period of inflation shortfall was likely driven by a 20-year cycle of globalization that has largely ended. In the aftermath is persistently high inflation and far less forward guidance for major central banks. Presently, Mike sees the potential for more downside in markets, especially as financial conditions, while off their lows, could need to tighten considerably more in order for the Fed to push inflation lower. In terms of the tail risks on his radar, Mike worries about a multi-year unwind of excess resulting from the stimulus that went into the market in the period after the pandemic. He also fears a potential showdown between central banks and market prices, especially the ECB and BOJ. I hope you enjoyed this episode of the Alpha Exchange, my conversation with Mike O'Rourke. My guest today on the Alpha Exchange is Mike O'Rourke. He is the Chief Market Strategist at Jones Trading. Mike, it's a pleasure to have you on the podcast today.
Thanks for having me.
Excited to have the conversation and really appreciate you making yourself available. We'll have a ton to talk about here, just in terms of both the here and now of global macro and risk indicators. It's certainly a fascinating time for folks that study cross-asset relationships. But as we get the conversation underway, let's first start with you and learn a little bit more about your career path and your career history. Tell us about how you got started in the industry.
I started working on the New York Stock Exchange floor back in 1995. I worked down there for a couple of years, and then I became a NASDAQ market maker. And then after that, after a couple of years of doing that, I was a proprietary trader. That was all with Spear, Leeds & Kellogg, which was obviously a big institutional trading firm that was acquired by Goldman Sachs in, I think it was 2001. After Goldman Sachs, I went to work for what was basically the predecessor of BTIG. Was in some trading roles there, and then I became the Chief Market Strategist of BTIG. I did that until 2011. And then from 11 to 13, I was a portfolio manager at Marshall Wace, a large UK-based equity hedge fund. And since 2013, I've been the Chief Market Strategist at Jones Trading.
Fantastic. Coming up on a decade in the same seat. And it certainly has been a decade in which we've had a lot of travel in markets. We've had these impossibly low rates. We're now pressing up against rates we haven't seen in a long time. We've had impossibly low inflation, and now nominal inflation levels no one could have guessed would have gotten this high, and lots of market spasms along the way, even in the last decade. And that's, of course, past the financial crisis. So you've been at this a long time. You've been in the seat studying markets for, almost 30 years. And so you've seen and observed a lot of change along the way. So what I'd like to do is just start with a little bit of history and just try to bring to life some of what you've learned studying markets through these periods of both very high and low vol markets. Take us back to the earlier days in your career and kind of talk through maybe some of the consequential episodes, whether they're monetary policy decisions that came out of nowhere or trades that ran amok. What are some of the early experiences for you that tended to be impactful to the risk framework that you use today? What are some of those early episodes for you?
Well, obviously the late 90s was an interesting time. You had the technology bubble building, or the internet bubble building, depending on what you want to call it. But also you had things like the Asian contagion and the Russian debt default and long-term capital in the late 90s as well. So you could get an appreciation for risk within an ongoing bull market that obviously morphed into a bubble. And then that 2000 to 2002 episode was obviously a pretty tough one for markets and kind of set, I don't want to say it set the tone for the next 7 years, but obviously the recovery to the 2007 peak was, I'd say, a cautious one. And then, of course, that all led into the global financial crisis, which was another episode that basically we're still living with the policies and the reverberations from that today. And I think a lot of the policies that came out of that episode have fueled massive imbalances that, drove an equity bubble coming out of the pandemic that likely peaked at the beginning of this year or the end of 2021.
Well, you mentioned Asian contagion, and it's literally 25 years to the day that this episode started. It was July 2nd of 1997 when the Thai baht had its first giant move lower. I think it was a 15% or so move in the currency. And that in some ways was a precursor to LTCM. And as you said, a lot of this happened amidst, if you kind of step back, a long raging bull market in equities. There were these big dislocations that occurred. But one of the things that's interesting as I go back to that Asian crisis is just the power of flows that these Asian currencies, these Southeast Asian countries had experienced and enjoyed just tremendous inflows for such a long period of time. And they themselves almost become defining in terms of the price of risk. And I'm wondering, as you kind of look back to either that period or maybe it's even as you mentioned, the tech bubble itself, are there any analogs there that make their way into your current thought process in terms of what the market's challenged by with respect to flows?
Well, I mean, I agree with you on flows. It's massive. It's the Soros reflexivity aspect of markets, right? Where that performance chasing that goes on just fuels bubbles until the point when they reverse. And when you think about that episode, especially I do think the tech bubble was really important, back in 99, 2000, and then the aftermath 2002 are extremely important for the market that we're looking at today, because having, traded those markets back then and believing we were in a bubble back then, seeing some of the stuff I've witnessed the past probably, 3 to 4 years, but specifically the past couple of years, I felt like the exuberance far, far outpaced that of what we saw in the late 90s, early 2000. So I tend to think, a lot of the episode we're looking at today, I expect it to be very reminiscent of that 2000 to 2002 unwind that equity investors experienced. And whether it was internet companies measuring eyeballs back then, or, companies measuring total addressable market today, or what's gone on with cryptocurrencies and SPACs, there's just been so much excess money thrown at the market on top of, trillions of dollars of monetary and fiscal stimulus just fueling those imbalances. So when you think back to those previous episodes, that unwind took 2.5 years to really play out. And still after it played out, the world didn't feel great, although obviously each year the situation got better and better.
There's always something new and different, even as we can learn from the past. So you're pointing to some of the similarities in that big tech bubble and then the collapse with excess debt. Perhaps it was concentrated in telco. And I'm just remembering it was the late summer of 2002, the VIX hit 45. I guess it started in some ways with Enron, but Adelphia and WorldCom and others followed. We haven't necessarily seen as much of that so far. We haven't gotten into a 40 plus VIX episode. So as you kind of overlay that period to this period and look for some of the similarities, but also observe some of the differences, what do you take away from that prior period in terms of it being instructive? And then what's new and different about this period that deserves its own analysis?
So it's funny, the past 20 years, 25 years, it all does tie together. And I think that's a lot of what is being missed right now as far as when people look at today's market. So if you think about the early to mid 90s, that's when NAFTA passed. In late 2001, that's when China entered the WTO. And from 1960 to 2000, US GDP averaged 3.6% per year. But you might recall coming out of that bear market or that, we had that small recession in 2001 after 9/11, and then that bear market in 2002, people kept talking about a jobless recovery. And that was, the big shift towards globalization had just really gotten underway. And basically the US economy structurally shifted to the point where we started sacrificing jobs and potential GDP growth in favor of offshoring manufacturing and things like that. And then what we got in return was lower consumer prices and higher corporate profits. So we had this jobless recovery that people talked about then. And, in 2002, Ben Bernanke was then a governor. He's worried about deflation, and he talked about his, principles of quantitative easing, obviously, a good, 5 or 6 years before he actually implemented them during the financial crisis. But that start of the globalization era was really pivotal because what we've had for the past 2 decades now is a very low inflation environment of price stability, where the Fed's primary fear has been running into a deflationary environment anytime there's a recession or slowdown. And then to the point where in August of 2020, Chairman Powell changes the Fed mandate for the purposes of, creating higher average inflation or more inflation, basically making sure that anytime we fell short of 2%, the Fed would provide more stimulus to try to keep inflation up. And then, of course, here we are in 2022 with the highest inflation in 4 decades now. And I think that's the key difference here is we've gone through this, the globalization era was a structural shift that happened in the US economy. The Fed has used so much stimulus the past 13, 14 years trying to achieve that pre-2000 GDP level of 3.5%. They finally realized there was a structural shift in 2020, changed their inflation policy, and now we're in a situation where the environment's shifting once again, and it has nothing to do with the Fed. It has to do with when Donald Trump came into office, he started pushing deglobalization. President Biden adopted a lot of those strategies. The world itself has shifted. It's not reversing globalization, but we've turned away from it as much. So you're looking at trends that are totally different now and a potentially new structural shift in the economy where even forget the pandemic, or when we get past the pandemic and the supply chain distortions, et cetera, we're still going to be looking at a higher inflation environment than we've seen for the past 2 decades. But the pandemic, of course, pulled a lot of that forward and showed those weaknesses. So now the Fed doesn't have the benefit of this low inflation environment or the globalization low inflation environment of the past 2 decades, where they could always come in and provide support to the markets. Instead, we're looking at a situation where the switch is flipped and they really have to be on top of this inflation issue and try to tame it. And the markets still are grappling with that right now. And that's kind of some of the same uncertainty we went through in 2000. The tech stocks peaked. Some peaked at the end of 1999, some peaked in March of 2000, some of the bigger ones. But the market kind of went through this tug of war up until September of that year. And then, people started realizing that move was over. That tech move, that tech leadership is falling to the wayside, and obviously was the beginning of a longer, prolonged downward move for the next couple of years. And I think, again, we're going through that tug of war right now in 2022, where people still have yet to fully realize there's a structurally different environment out there, and we're just in the beginning of that adjustment process.
In your role as Chief Market Strategist, you obviously have a pretty significant focus on equities. But our conversation so far is really focused on a lot of things that originate outside of equities. And we're focusing on the central bank and how its mandate changed and how its opportunity set has changed. You started in this role in 2013. So this is the original taper tantrum. That this is the first kind of shock of, oh boy, what we thought the Fed was going to do, it's very different, at least for a short period of time. But we did have this long period post the financial crisis that was this, as you said, disinflationary period. The Fed was kind of stuck at zero doing extraordinary policy, trying to get inflation up. If you can, try to walk through your thought process in those post-financial crisis years, that long strip of years where GDP was 2%, rates were 2%, inflation was 2%, vol was low, equity markets did well. What are some of the lessons from that long period in terms of the interaction between the Fed and markets? What was on your mind at that time?
Okay, clearly that the Fed should have kept to the promises that Chairman Bernanke made, which is that the extraordinary measures related to the global financial crisis were extraordinary. And what happened was we morphed to this environment where the Fed felt they needed to coddle markets, undercut every downward move. Again, that taper tantrum is a great example that you bring up. People worried about tapering in 2013. So from, I'm going to say May or June of 2013, the 10-year Treasury yield rose from, I think it was 2.4, 2.5% to 3%. Well, the Fed never tapered. And as a matter of fact, they started QE3, immediately after that. And again, you're looking at an environment then where interest rates, again, they were at 3%. So the Fed has played a big role in whether we could say fostering a low interest rate environment or fueling it. They've made themselves a key market player. And that the same goes for the Federal Reserve, the ECB, and the worst example would be the Bank of Japan, where you actually lose a lot of the very important signaling from asset prices from markets. The reason we use markets is for the proper allocation of capital. And when the central banks become too steeped in it, those signals disappear. And I think what happened in that, the past decade is that you create this lower volatility environment, as you know. I also think those policies also fostered the rise of indexing, right? Because you had central banks constantly supporting every downturn in equities. So the public said, "Oh, I'll just buy the index." And again, while indexing is a great strategy for individual investors, it's an inelastic buyer. They'll buy if the PE is 5, 10, 15, 20, 200. So you're not getting a good market signal from prices the more passive investing comes to dominate the asset flows. And obviously that's been the big shift we've seen in the past decade, where passive investment has overtaken active investment.
That's really interesting. And I had as a previous guest, Robin Wigglesworth, who wrote this book called Trillions. It's on the history of indexation. At the end, he does entertain this concept of the price signals being compromised by just the force of capital that is passively managed. And this kind of brings me back to flows. And I just, again, love to get some of your take on this. You do see episodes where flows can push valuations either well above or sometimes well below fair value. I've seen this in equity volatility where vol is impossibly high just because it's being covered in a hurry. One of the charts that I've come across, and I'm sure you've developed these and seen these yourself, is just the size of the equity inflows, especially that occurred post the pandemic. It's as if this, and some of it's passive, some of it's active, but boy, it's a monster number, at least for, up until, let's say, the beginning of the year, the amount of money that just went into the U.S. equity market. And I just would love for you to just walk us through your observations on those flows, what the implications are. And then, from a forward-looking standpoint, how does the force of those flows figure into how you see things materializing from here?
So, yeah, obviously the pandemic just created this boom, and there was obviously a high level of savings during the pandemic because people couldn't go out and spend. And then on top of that, like I said, trillions of monetary and fiscal stimulus out there. So talk about a tidal wave of capital coming into financial assets. It was too much for markets to absorb. And I think that's the problem we encounter Is it, if it all comes in at once, you create these massive imbalances. Obviously, you see the big price moves, and people tend to feel validated when prices move in their direction. And it's just something that I don't believe the market could fully digest. And that led to obviously massive moves higher. And now I think we're seeing the flip side of that this year. Obviously, with the big headlines last week, or at the end of Q2, was this is the worst start to an investing year for the S&P 500 since 1970, in 50 years. And I think that's the negative side of what we've seen. And again, it just shows the policy wasn't structured, effectively or properly to allow all this to occur. But we could talk about the policy mismatch for a long time. I mean, we're sitting here talking about how bad the inflation situation is, and that's the number one concern on every American's mind right now, and most people in the world's mind. But the Fed was still buying assets as recently as March. And so one can understand why investors felt like they have this protection, or they have this easy Fed who's always going to be there to support them, or when the market does correct, they're going to come in and provide a soft landing. And like I said, the inflation situation is one that they can't afford to take that chance here. And it's just incredibly different than anything people have seen over the past 20 years because of that globalization driven low inflation environment that we're in.
It was almost as if the globalization was just really misunderstood in terms of its import on creating this very low inflation. And it seems to be quite a reckoning now. And as you mentioned, the Fed trying to risk manage inflation without a true sense as to where it's going to go from here, it's kind of forced to do things that are pretty market unfriendly. So it's quite an interesting set of circumstances right now. And I'm sure just in terms of your day-to-day, again, trying to glean where equity market opportunities and risks lie, there's a lot of central bank study that comes into your work. And what I've seen in some of your recent writing is just on, for example, Jordan from the SNB talking about the Swiss National Bank not being in the business of forward guidance. Walk us through just central banks and just in terms of your study of them in here and now. You also mentioned the Bank of Japan. What role do those play in your assessment for U.S. equity markets and the clients of Jones?
Well, I wish they played less of a role, I could tell you that. The problem is they've become the market in so many cases, and that's one of the primary problems here. So it's funny, like here's some numbers when you think about the past 2 decades. PCE inflation is the Fed's preferred inflation target, right? So with all the talk about the Fed's target, all the different policies moves it's done over the past 2 decades, PCE inflation has averaged 1.88% over the past 2 decades, 12 basis points below the Fed's target. So it's crazy to think that, and at the core level, it's 1.8%. So we've had price stability, and like you said, they missed the fact that globalization provided that price stability. In the same respect, the Fed funds rate has averaged 1.3% or 1.3% over that same time. Now, if you look at the Fed's forecast, whether it's the summary of economic projections, which they started publishing, where their longer run Fed funds target was, it was above 4 back then, and I'm sure prior to that it was above 4. Now it's about 2.5. So for 2 decades, we've not had a policy, the Fed funds rate at neutral. Yet we've had record highs in the stock market. We've had obviously big ups and downs in the economy. So again, the policy has been mismatched for the economic environment. Prior to the Bernanke Fed, when Chairman Greenspan was at the helm, he's almost as guilty of doing similar things as far as supporting markets, but I do believe he tried to let markets clear, and he was not averse to an intermediate heightened move to keep investors honest and to keep speculators from overstepping and becoming too big a player in the market. And it's funny, if you go back, he has comments that he did an interview for the Fed's Oral History, and he talked about he was asked about the inflation target and whether it should be public or not, and obviously became public under Bernanke. And he said, well, the inflation target was always there. It was always between 1% and 2%. He goes, there was no need to make it public because it limited the Fed's flexibility in administering policy. And I always thought that was a smart statement. They knew inside the Fed what they were aiming for, but they didn't want to be handcuffed into doing anything should certain economic data go one way or the other. And the Fed still does that today with the unemployment rate. They're hesitant to say there's a technical full employment rate because they know it shifts with the economy. So what we've seen now in the past, 13 years is the Fed micromanaging, and I can point back to comments by both Yellen and Bernanke prior to the Fed inflation target becoming formal policy or public policy, talking about it should be between 1% and 2% or 1.5% and 2%. And as I just said, that's what we've had for the past 2 decades. Ironically, April of last year, when inflation started ticking up, and Chairman Powell was asked about, is it time to start to taper? And he actually responded saying, well, inflation's at 1.7%, we want it at 2%. And here you're talking about a Fed chairman trying to micromanage the inflation target. And, the tool to do that was, obviously with zero interest rates, was continue significant asset purchases. So these central banks have become a destabilizing force in the global economy. And that's obviously why every time they continue to increase these policies and further increase their balance sheets, it becomes that much harder to unwind. And that's the problem with what we're dealing with today is, you hear Chairman Powell testifying in front of Congress a few weeks ago, talking about how the forward guidance, the market's in line with the Fed on the forward guidance. We just actually haven't raised the rates yet. Well, again, this is why you're behind on policy. This is why every time you raise, despite whether if inflation starts coming down, you still have to tighten. If unemployment goes up, you're still going to have to tighten. You're behind the curve because you built so many imbalances into these policies. I'll give President Jordan some credit from the Swiss National Bank because he said, we're going to do what's right for Switzerland, and we're not going to tell you everything that we're going to do. And I think that's one thing that's kind of lost among central bankers in Europe, especially the United States and Japan today, is they're trying to lay everything out for markets where you need that degree of uncertainty because that actually leads to better risk management among speculators. I think one of the biggest, failures, you go back to the global financial crisis and the housing and mortgage bubbles that led to it. Even Chairman Greenspan, after obviously he left office and had to testify, admitted his mistakes, that he thought the free market was going to police itself. And what actually happened was as the Fed followed this policy for about 2 years, maybe a little more than 2 years, they raised the Fed funds rate 25 basis points every meeting. And what you had back then was a bunch of carry traders who were borrowing short at lower rates, lending long at higher rates, making that spread. And then with each 25 basis point move, that spread compacted, right? So they started applying more leverage. And because they knew where rates were going to be, because the Fed had telegraphed everything so easily to them, by the time the spread had gotten to its tightest levels and the rates got to their highest levels, they had on the most risk. And that led to the big unwinds in the asset-backed commercial paper market, and obviously the mortgage market and the structured credit markets that basically fueled the global financial crisis. So there's a lot of value if the central bank goes out there and does not publish everything or signal every move they're going to make, because it forces markets and investors to then quantify the risk they're about to take with a degree of uncertainty, making it a lot harder, which means they'll be much more diligent in their risk management. And I think we've gone totally away from that. So you have these largest imbalances at the highest, most expensive levels. And obviously, it's the most painful point to unwind from.
I really couldn't agree more on this transparency. In general, there's no free lunch in life, in markets, and there is a downside to the transparency. I got my start a little bit before you. It was in 1991, and I was supporting the chief economist at Nomura Securities. And back then, the word Fed watcher was a real thing because you had to really decipher what was happening. On Thursdays, we would get this H41 report, which was a reserves report in the afternoon, and you'd try to tease out whether the Fed had actually changed its policy. They never told you anything. You had to actually figure it out. And I just was coming across this quote from Greenspan. This is from 1987. He said, "If I seem unduly clear to you, you must have misunderstood what I said." They used to call, right, there was Greenspan purposeful obstruction or obfuscation was the term. And so talk to us a little bit more about the current day. You're kind of contrasting the Jerry Jordan, or is it Thomas Jordan, sorry, from the S&B against some of the more coddling folks, maybe it's at the ECB or the Fed. In terms of central banks, who do you have your eye on? Of course, you're watching the Fed, but what other central banks are meaningful players in this? And again, I'm bringing it back to the U.S. equity landscape. What are the signals that you're watching from other central banks that might have some impact on U.S. equities?
I tend to keep my focus obviously on the Fed and the ECB and then the BOJ because I consider those the three largest, I guess, quote unquote, free market systems, even though I think everything I've just said they're not as free as we like to believe they are. And I think the BOJ is in its own world at this point where they're just buying everything and kind of just going down a very dangerous path and they don't know how to stop. So that leaves us with the Fed and the ECB. But the ECB is interesting here because 15 years ago, the Bundesbank would kind of be able to put their foot down and all the legality of the creation of the euro or these obligations or these requirements that countries had to meet, which have kind of been thrown out the past 10 years since the financial crisis. But you have this anti-fragmentation tool that President Lagarde has been talking about, which is, taking the reinvested securities from their pandemic purchases and buying sovereign debt of the peripheral nations that's, higher yielding because obviously Italy does not have the same profile as Germany as an investment. And that's interesting because, again, we're talking about here's a central bank, interceding in the markets and preventing that signal from being given to Italy to, clean up its balance sheet. And if that's how that will work for a period of time, and obviously it will keep markets placated, but when you hit a point where something unwinds or a point where you can no longer control the variables in the environment, and that's that inflation metric is what we've seen here for a long time. All the variables work to the Fed's advantage as far as being in a low inflation environment, allowed them to continue to buy assets and be supportive of markets as much as they wanted to. Well, now the inflation that's out there is beyond their control, and that's where they're being challenged. So I think that's the main issue that I'd be watching with all these central banks is they're still trying to control as much as they can, but again, they're actually preventing true market pricing from coming through, and that does lead to greater risks down the line. The question is, at what point do they get realized? In some cases, some cases it takes decades to be realized, but again, you have another tail risk event like the pandemic, these things become very dangerous. But I think that's what we're grappling with here is the central banks are realizing the environment's not quite as benign as it was, and they have to be very careful as to how they proceed.
So it's a really interesting time frame. Just with inflation, you've got incredibly high levels of interest rate volatility. Last I checked, the move was in the 130s or 140s. FX volatility is quite elevated after going through a very, very long stretch of being extremely muted. So things are happening in all kinds of sister asset classes for equities. Your job is to bring all this stuff together, again, with a focus on the U.S. equity market. Talk to us about your dashboard. If someone was to get a look at your Bloomberg launchpad, so to speak, and the kind of indicators that you're looking at for price discovery, you've mentioned that some of that price discovery is compromised, but prices are all we have. And you're looking at a lot of different indicators at once. Talk to us about some of the most prominent drivers of your thought process right now in terms of items on the dashboard.
You bring up a couple of great points there. For a long time, I have had so many different factors that I looked at, and I do feel like so many of them have been marginalized by the different flow environment out there, whether it's more passives, and obviously, again, I do believe all that's magnified or supported by the central bank activity. So I don't think passive would have had this big wave of growth. I think it would have continued to grow, but not in the manner it did, if not for the central bank support of the past decade. But so for the environment today that we're looking at, the number one metric that I am very focused on is the S&P 500 market cap to GDP. And back in 2002, it peaked at 120%, and that was during a bubble. This time, we've gotten up to 180%. And from that perspective, that was the beginning of this year. So there was obviously a lot of excess as far as market cap or valuation out there, expensive valuations. The average going back to 1990 is about 80%. I think right now we're about 138% of GDP. So we're still expensive. We still have a significant correction to play out here. The next most important thing right now in this environment is probably financial conditions. And the Fed themselves have talked about financial conditions. Obviously, there's numerous different financial conditions indexes. I've been using the Goldman Sachs Financial Conditions Index. And what I see there is, yes, we've tightened from the record easy environment of the past 4 decades that was at the end of this year and the last year, early this year, but we're still only back to about 2000 levels. So I think there's still more that financial conditions need to tighten. And of course, that would show up in the stock market if stocks went down. The other things that I'm looking at are, the S&P earnings yield, and of course, where the 10-year treasury yield is. And basically, I like to add these together, and I call it the reverse Fed model. Ed Yardeni called it the Fed model when he saw the Fed comparing the S&P 500 earnings yield to the 10-year treasury yield. And I feel like when you add the two together, you get an idea of where the risk or how much risk premiums are getting priced into the market. And, while these numbers have come up, historically, when you see the CPI run up as much as it has, they come up significantly more. Or you'll even just see, even if you just look at the S&P 500 earnings yield, I think it's a little over 5% right now. Usually it's probably, I'm going to say, around 4% below the misery index, which would be the unemployment plus CPI. And I'd say right now we're probably about 6% below it, or 6 or 7. So I'd sit there and say that's another sign to me that equities have more correcting to do. Those are the measures I'm looking at today, but I think they're very specific to this environment, being that I do believe this is, we're coming out of a bubble-like environment similar to 2000. And I think we've seen similar speculative excesses that we saw in the late 90s and early 2000. And I think, going forward, when I see these numbers start to show more improvement, I'll be more constructive, but I think we still have a good, significant amount of time before that occurs.
There was a lot of discussion in markets in that lean period, that 222 period of growth, inflation, and rates that persisted for most of the decade post the financial crisis, that the market multiple should be higher because inflation and rates were lower and very stable as well. And that has seemingly come undone. And certainly you can argue that the market multiple has come off quite a bit. That's the first part of the question, is how should we think about the earnings yield or the PE ratio in an environment where inflation and inflation uncertainty are higher and persistently so? And then the second part of the question is kind of bringing it all together with earnings. And as we look forward, we had an earnings season coming quite quickly. Is the market, as market prices, the 20-odd% drawdown we've seen in the S&P, has that just front run an earnings decline so far? How well positioned is the market for earnings this earnings season with respect to what companies report and how they guide?
That is a great question, because obviously you go back to the 70s, early 80s, you have, single digit PEs amidst those high inflation environments. I think here we are today, we have inflation above 8%. I don't think we're staying above 8%. I think by the end of the year, obviously we'll start to decelerate. But I would say the multiple should be closer to, let's just say the historic average is 16 over the long term. We should be closer to that or at a discount to that while inflation's high. And I believe on a trailing basis, the S&P is around 19 now. So I think there's still more correction to come, in that area. As far as the earnings season, like you said, we've had this 20% decline. Companies, we've seen a handful of pre-announcements. I don't think we've seen a meaningful amount of pre-announcements. And I think companies were waiting to see how things are progressing, and we'll get more meaningful guidance when earnings season starts in a week or so. I think the next 6 weeks is going to be this tug of war between improving inflation data and deteriorating earnings pictures. Earnings estimates have not really come down, which still needs to happen. I don't think markets have priced in how we're going to come out of this earnings season, because I think the other thing that is also going to be lost here and tends to get lost when people are only looking 1 or 2 quarters out is that one of the key aspects of what I'm talking about here is this structural shift in the economy and this shift away from globalization. Like I said, I don't want to say we're not fully deglobalizing, but those benefits of globalization were, at least for now, it's looking like one-time gains for the past 2 decades. So it's just going to be much more challenging going forward. So you're not going to have the same earnings growth. You're not going to, again, like I said earlier, we traded jobs and GDP or potential GDP in the United States for, lower consumer prices and higher corporate earnings. So if we start onshoring those jobs and boost our GDP, which is obviously good for the United States, it should be a drag on earnings going forward. And I'm not saying, again, it's hard to make a forecast, or it's hard to put a number on where that trend is. But I think it should be safe to say that 2021 represents some type of peak in earnings for the cycle, and that the next couple of years it's going to be more about seeing where the new trend for earnings, for S&P 500 earnings is, and how businesses are managing that structural shift in the economy. So I think a lot of the second half of the year is going to be spent as investors try to figure that out, and we go through gyrations trying to figure out what the secular trend of business is, and what the quote unquote new normal would be, being that the last episode of globalization has come to an end.
So far, we've talked at the index level, and we've talked about the large drawdown in the S&P, but of course, it's composed of sectors. Some people factorize it. I'm looking at XLV, the healthcare ETF. That's just down 7%. Energy was a huge winner for a period of time. That's obviously come undone quite a bit recently, but set against tech, the XLE was outperformed it by just an absolutely gigantic amount for a couple of months there. So there are these winners and losers in this environment of monetary policy uncertainty, higher inflation. Talk to us about that, just in terms of the underneath the hood, maybe with an eye towards what does better in a higher inflation environment, what might get more compromised. Where should people focus on, both long and the short side, underneath the hood, let's say, of the S&P 500?
I've been a big proponent of rotating towards value. It's also interesting, for 15 years, ending during the pandemic, value had massively underperformed growth. And when you had that recovery environment, interestingly, actually it went from the bubble peak in 2000 through 2007. That was an environment where value outperformed. And like I said, since I think we're in that type of episode, I'm a proponent of that. 2 of the key sectors within that group have been financials and energy, of course. I like energy because fundamentally, obviously, they trade at a lower PE. So from that basis, their valuation is attractive. But also the lack of an energy policy in this country, or this attempt to decarbonize the country, doesn't have a real plan. So if you're fostering less investment in the space, it's actually going to be good for the companies that are in that space. I think we've seen that play out. And then there's been the added influence of Russia's invasion of Ukraine. So the risk to energy right now here is if we wind up in a recession later this year, which I've not been in that camp, but I'm moving closer to the camp where I think that's becoming a much higher risk. The other space that the other group I like in there is the financials, especially the banks. And obviously they would tend to benefit from a higher interest rate environment. What I really like here also, though, is that their positioning is so much better today than it was, say, in the global financial crisis, or even in 2020. You had the episode of all these corporations drawing down their credit lines when the nation shut down. And the banks were a major indirect beneficiary of the policies that the Federal Reserve unrolled, in the sense that all these corporations re-liquefied themselves, sold debt, sold equity, they raised capital, paid back their credit lines. So I think the banks are in a much better position. Of course, they have a more attractive earnings profile as well. So I think those are the groups, and I would definitely be on the more defensive side of the spectrum. But there's very few things that I like on the long side. I think growth is still going to correct. I think anything that's a high multiple name is still going to continue to correct. I think the one thing investors have to be aware of is we're going to continue to have episodes, even if the earnings come out and disappoint, like we saw the past few days. Even yesterday, you had a big growth rally. That's because interest rates went down, and that was, to me, it was very mechanical model trading, where interest rates, the 10-year yield drops, and money flows into growth. And I think that just prevents us from getting to where we need for that capitulation clearing event in the market. So I don't think we're going to see the market just all of a sudden be priced at an appropriate level, but you're just going to see different rolling corrections amongst different groups that eventually you'll be able to find places where there is some value. I think what we're looking at is, obviously, and we've seen it unfold already, is these leaders during the past, during the pandemic, or 2020 and 21 during the rebound, they're getting hit the hardest, and they'll probably continue to get hit as this continues to unfold. And then the mega cap growth names, they've been big beneficiaries of the environment of the past 2 decades. And, now that, some of them are now $1 trillion companies, and some came close to $1 trillion, it's not going to be quite as easy going forward, and they're going to have a period of multiple compression. To go back to that 2000 analog, when one thinks about the rise of the internet, and it's the internet revolution, it's going to change the world, and PCs are going to change the world, and all these things actually happen, whether you look at like Cisco Systems, or you look at Intel, you look at Microsoft, the companies that led back then, their businesses grew exponentially. So the fundamental story there was correct. What happened over the next 10 years was the multiples compressed. And I think we're going to still see that we're going to see that type of episode with some of those growth leaders today, where there's still going to be great companies. There's still going to be incredible parts of the American corporate structure, but they're not going to trade 50, 70 times earnings.
Well, we talked a little bit about indexation, and certainly, even if you're not explicitly indexed, there is some quasi benchmark hugging that everyone is forced to do. The comp always seems to be the S&P 500, even if you call yourself absolute return. And here's where I wanted to go with this, just as you paint a picture where there certainly could be conceivably more downside in the market. Folks do struggle to be invested. They find underinvestment sometimes to be a risk. And then at the same time, we've had this awful coincidence of a drawdown in both the stock market and the government bond market. So the 60-40 portfolio has gotten hit pretty hard. How do you balance that from a risk management standpoint? The need to be invested, the reality that prices are lower and there may be a better entry point here, versus your view that there could be more downside. What's the way to middle this from a risk management standpoint?
Well, obviously, everyone has their own risk profile, and whether it's individual investor or a fund, and everyone has their own individual mandates. When we started, you were talking about risk and reward and those terms out there. I definitely like to think in terms of risk and opportunity. And I think, one of the lines that I think is important is if everything is out there is expensive, which is, I'm going to say where we were a year, 6 months, 8 months ago, a year ago, then by default, cash is probably cheap, right? Or the safest spot is cheap. And I think you always have to think you're not investing for today's environment. You're investing for next year's or 5 years from now. You're investing for some future environment. And I think it's important to say to yourself, if I'm invested here today, will I get better prices in the next 6 to 12 months? Obviously, in my case, I believe you will. I believe that goes for stocks or bonds. We're talking about a totally different environment than most investors have witnessed for the past 2 decades, at least from my vantage point. So I would rather be more defensively positioned and look for those opportunities. The same respect, I would have also been more cautious the past decade. And all this Fed policy and the liquidity, and of course, during the pandemic, the fiscal stimulus, as a result of that, the past decade, you've probably had high teens and average annual returns for the S&P 500, doubling the long-term historic average. So it's a challenging episode to miss opportunity with that. But in the same respect, you have to believe in what you're investing in. I like to say, if you were right in 1999, you probably got destroyed in 2000. And I think it's the same thing here today. If you were right in 2021, you're probably in a lot of pain in 2000. And you just have to find what investments over the long term that you're comfortable with. And you have to be strong enough to be willing to underperform the market in certain years, because you're probably going to outperform in other years. And I think people have to get away from that group thing. I think one of the downsides of the passive investing wave that's gone on the past decade is being long the S&P 500 is probably the most crowded trade in the history of the world right now. And as long as you're aware of that risk, and that's fine, you're comfortable with that, then great. But for what I do, I don't want to be in the most crowded trade in the history of the world. I'd rather have some cash and be on the sidelines and wait for a better entry point.
Yeah, you're pointing to the sheer force of this behemoth called indexation. And if you are on your Bloomberg terminal and you want to look up the holders of Apple or Amazon or Microsoft, you're going to see BlackRock and Vanguard at the top in every single one of these stocks in a big way. And they're not studying the stocks. They're just putting the money to work as per the formula for indexation. Well, let's finish with this, which is in terms of the tail risks, the things that could go remarkably wrong from here that might not necessarily be fully contemplated. We have a VIX that's certainly high nominally for sure. Anytime you're in the very high 20s, it's going to score in the maybe 95th percentile from what we've seen. But certainly during very fragile markets, we've seen a VIX in the 40s and occasionally even much higher than that. What are the things that are the out of left field risks to the U.S. equity market that might not fully be factored in or contemplated from here? What are the things that worry you from a tail risk standpoint?
I'm sure if I say anything, it's not going to happen. But I think it's the whole policy aspect of this market. I think the Fed has gotten too big with its balance sheet. I think policy has become too hard to unwind. And then you think about, well, if they are truly serious and you take them at their word and we're going to see higher interest rates, that leads to, larger financing problems for the national debt down the road. So there's a lot of, larger implications of things that could potentially go wrong. But the number one thing I fear for the equity market right now is this episode where it's a multi-year unwind of excess. Like if you think about how over the span of 18 months from mid-2020 to the end of 2021, all the fiscal and monetary stimulus that went into markets, just the unwind, or just not the unwind, just the fact that new money wasn't coming in, or that new impulse was not coming into markets, is a fiscal and monetary cliff for markets and the economy. So those, of course, lead to slowdowns. And then, again, we go through this adjustment in 2020. And like I said, it takes a long time to find out where that real secular trend is. It can get much more painful if it does wind up where the market goes down another 20%. You know, that's gonna feel very painful for investors, and that long drawn out process just is really it's just challenging. As far as other risks, it's one of those things. When things get bad, they tend to get worse and worse and worse. So you look at the situations with what the ECB is doing in Europe, and the fact that they have to defend peripheral sovereign debt right now. You look at the Bank of Japan not giving way on their yield cap. Again, what happens when these central banks step away from the market or markets overwhelm them? I think those are risks out there that rightfully would spook investors, because those are part of those, these interventions all led to lower volatility the past decade or past 12 years or so. So again, every time we keep talking about the VIX and where it's at, well, once markets start reasserting themselves, well, you're going to wind up with a higher volatility environment, and forget about if there's actually a point where a central bank is, can no longer maintain the policies that they've been pursuing.
Yeah, I think peg breaks are amongst the most violent vol events. And we talked a little bit about the Asian financial crisis at the top of our call. And in some ways, the BOJ is continuing to try to enforce a peg here amidst global forces that are certainly not their way. The other thing you said, I just thought was really interesting, that when markets get compromised, it tends to create the conditions for further deterioration. And I think one of your pieces you wrote, broken markets break down, which I really liked. I really like that framing.
Yeah, it's funny when a news cycle breaks, whether it's an individual company or the markets. A lot of time, if performance is well, or if there's strong performance, the negatives are somewhat ignored. But once performance starts to fade or flounder, then all of a sudden people start looking at those negative developments with a little more scrutiny. And I mean, the one thing that came to my mind was during the global financial crisis, as Bear Stearns unwound, because there was a little more of a longer drawn out process than Lehman Brothers before, JP Morgan acquired them. The negative stories continue to snowball as the situation escalated. And I think, again, once performance starts floundering, all of a sudden there's a much more scrutiny on the situation, and people pay more attention, and they're a little more discerning. And then again, it manifests itself in the share price.
Well, we will leave it there, Mike. It's been an absolute pleasure to spend the hour with you. I'm glad we had a chance to do this, and I'm sure our guests are going to enjoy this episode. So thanks again for being a guest.
Thanks for having me. I really enjoyed it.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.